Hi, in this module, we'll discuss about high watermark. High watermark or hurdle rate typically would be around 8% is the minimum return that the limited partners must receive before the general partner or GP can earn carried interest. And this protect LPs by ensuring they get baseline return first. In other words, I would like to quote like you see the this 8% would be the cost of a capital, so that every investor expected. Every means every investor expected. All right. So how it works? Think of it's like preferred return. LP get their capital back plus the hurdle rate return compounded annually before the GP participate in profit beyond management fees. All right. Look at this calculator. Let's say fund size, which is at a 500 million, and hurdle rate, which was at 8% for a 10 years. So hurdle amount would be $1,079 million. Then only the I mean the profit will be distributed with or share with the GP after this only. So it means fund should perform minimum at least thousand means $1,079 million. All right. So look at this here. We have an example. Let's say look at this. The LP invested 500 million and hurdle at 8% for 10 years would be around almost 1079 million. So if you compound it, right? So LP's preferred return, so that is something around 579 million. So that goes to the means capital plus 579 million that goes to the LP. All right. Before gets GP their carry, then LP must get this amount 1079 million. See, in a hedge fund, base would be NAV. So on the basis of NAV, basically high watermark that we calculate. But in a private equity, so we calculate on the basis of capital and preferred interest. So that we basically add it, and that we return investor first, means limited partner first, and then only the GP will calculate or ask for their the carry fee. All right. If the fund returns, let's say means fund has achieved 1500 million total, then LP get their 1079 million first, and then remaining 421 million is split as per the carry fee agreement, like 20% goes to GP and 80% goes to LP. So look at the advantage here. So basically it protects the against mediocre performance. So it means LPs will be get basically protected. Then ensure minimum returns before GP profits, align GP incentive with performance, and common market standard typically 8%. So disadvantage should would be like it reduce basically for a GP, reduce GP's economics on moderate returns, and compounding effects increases hurdle over time. May discourage early distributions, of course, and complex would be the calculations with the multiple exits and all. So this is how basically the high watermark works in this context. So now I would like to quickly brief about even clawback as well, like how clawback works in a private equity, because in means the high watermark, clawback, preferred return, that all comes under or all are part of waterfall. So let's discuss that as well in this session. So look at this. Now if I talk about, let's say, GP clawback. All right. So a clawback is a provision require the general partner to return carried interest distribution if by the end of the fund's life they have received more than their agreed upon share of profits. Why is this needed? GP receive carry on a deal by deal basis as an investments are exited, and if the early deals are, let's say, very profitable, but the latter deals lose money, the GP might have been overpaid. The clawback corrects this at a fund's termination. This is a legal protection, I would say, and it protects the LP's interest. And clawback would be part of deal by deal model. In a whole deal model, hardly you would see, or would be like a rare case where you would find the GP clawback. But in a deal by deal model, you would see by default, the GP clawback will apply it. So now look at the example. Let's say we have 200 million fund with 20% carry, and early exit, investment A exit at a 150 million gain, where investment B exit at a 100 million gain. So total profit was so far like 250 million, and the GP received carry 20%, which was around 50 million. Basically, it was received to the GP as well, right? Because in a deal by deal model, what happened? So once we sell investments, so after every sell, we'll also process the profit share with GP. All right. So in a first example, look at this here. We have shared the profit of 50 million to GP. Then in a latter exit, what happened? Investment C was in loss of 80 million, and investment D was in loss of 70 million. So net fund profit, the loss, it was around 100 million. Why? Because so 80 million loss in C, and then 80 million loss in D. So if you just calculate the total from the first deal to second, so would be around just 100 million in profit. So now here you can see a clawback provision. So GP should have received 20% of 100 million, right? So which is 20 million, and GP actually received 50 million. So it means in a clawback amount, look at this. So 20 million will have to return, means GP will have to return that back to the partnership or partners. This is how basically, guys, clawback works. All right. So look at the here the simulator. Look at the 20 million. It was the early profit, but late losses incur around 150 million from the C&D investments. So carry percentage, we have a 20%. So GP was paid as a carry fee around 50 millions, but actually means at the end of the investment, actual carry, it should only 20 millions. Why? Because so net profit, if you look at this, see 20 million, 250 million profit was in a first and second deal. Then in another deal, there was a loss of 150 million. So net, if you calculate, only 100 million would be the profit. So eventually, so we should pay the carry fee on just, on 100 million profit, right? Not on 250, correct? So initially it was paid because in a deal by deal model, what happened? In initial days, let's say exit, if the profit, if the deals were, let's say, in profit, then of course we'll have to pay the carry to the GP. Then later on, at the end of the termination, that will be corrected out, and that's what we have done the same thing here as well. So look at this: the clawback day would be 30 million, and carry fee, would be just 20 million. So 30 million, the GP will return to the LP at the end of the termination of a fund. So look at the important clawback details so that you should know it. So timing is very important. Typically calculated at a fund liquidation, end of a life. So this clawback will be calculated at a termination of the fund. At that stage it will be calculated. Then GP reserve. So some GPs with a hold would be like 20 to 30% of carry in escrow to cover potential clawbacks. Then after tax, like the most clawbacks are calculated on an after tax basis. So meaning GP only return their net amount after calculation of a tax. Then no fault, like clawback is not a penalty, it's a true up mechanism to ensure proper profit split basically. And then whole fund calculated across the entire fund, not per LP. So though allocated pro rata basis. So basically clawback will be calculated on whole fund, and then that will share with the LPs on the basis of pro rata, it means as per their capital contribution. So that's how, guys, the clawback works in a private equity. So still, if you have any question, put a comment, so I would like to address it. So but yeah, that's how clawback works in private equity. So any question still you can ask, I would like to answer it. So thank you very much for watching this. We'll see you next episode. Thank you.